So we come here with another video for you on REITs by reitspro.com, a place for insightful content on REITs and InvITs dedicated for India. Today we talk about REIT returns and we reclassify them to include something called in-hand returns. Now we all know about pre-tax and post-tax returns, but in REITs we are going to classify an in-hand return as a third category. And thanks to a lot of queries based on video dated 26/5/2022, we are taking this video forward here, and we are going to basically talk about why we got into the complication of the pre-tax and why that video talked about it, and why not just do a amount received by price formula and get on with it. So the reason is to reclassify is because of the nature of tax efficiency of REIT instruments. Now, as we know, REITs have a large part of in-hand income which is tax-free. Now, the wrong classifications on our end would lead us to erroneous investments, and how that happens we would like to clarify here. So an investment decision, there could be a possibility of error if we consider two scenarios. For example, we say that we earn 21 rupees a year for investing 350 rupees in a REIT unit. That means we are getting a 6% return. Now we see an alternative of a fixed instrument at 7.5%. So do we say that that's better? So this results in a comparison which is not really an apples to apples comparison, but something like this, an apples to oranges comparison. Why? Because to truly evaluate, we need to ignore the yield calculations of returns by price, or just a simple formula of 21 by 350 into 100, which is the in-hand return. Now, why ignore can be given with the example of a FD return of 6% vis-a-vis a REIT return. So on an FD, for example, if you see the diagram on the left, income received and you pay tax, and there is a net post-tax return. So a 6% FD of 1 lakh would give you a post-tax of 4,200, and a pre-tax. Now pre-tax in that case would be 6%, simply 6,000 rupees. In case of a REIT, however, 1 lakh rupee investment would give you 6,000 distribution, which is assuming that you have a 6% return on the instrument distribution on purchased at a price of 1 lakh rupees, 350 rupees. So 6% of that would be 6,000 rupees. Now assume a tax rate of 30%, and since the taxable part is only 1/6, the tax would be 300 rupees. So the post-tax is very well 5,700. So distribution received in the left-hand chart, distribution received, you pay tax, you get a net post-tax return. That's fair enough. So if you see post-tax is good enough to see that, and on this slide, you can see that the post-tax of 4,200 compares with the 5,700 post-tax returns, which is fair. But is the pre-tax 6% and pre-tax 6% in both cases correct? So a lot of times you could pause here and see the calculations here, because this, a lot of times you make a decision mistake in this case. Making a decision could get misplaced in this case. And why this happens is because we generally evaluate things like, this gives me 6% and this gives me 7%, like we've talked about debt instruments versus REITs. Now, that is why it is probably important to get on to the pre-tax return for an easier comparison. Now, let's get down to how the REIT distributes its income. So a REIT distribution would, again, I would explain here that interest, return of capital, tax-free dividend, and taxable dividend would be the 4 components. And out of that, return of capital and tax-free dividend would not be taxed. These would be tax-free. The other 2 would be taxed. So taking the case of Embassy REIT again on Q1 22-23, the interest income of on that was 65 paise, and amortization and dividend tax-free. Both of these in green would be tax-free. So the total distribution is 5.33 rupees. Now, what is the in-hand in that case? It's simply a total of all these 3. So 4 rupees 68 paise, which is a total of the ones on green, 185 and 283, 468 and 65. So simply in hand is 5.33 divided by 365 would give you 1.46% for the quarter. Now moving on to post-tax, if you see the post-tax here would become 5.14. Why? Because 4.68 will not be taxed. The first row, 0.65 will be taxed at 30%, assuming a 30% tax bracket, and a post-tax amount of 5.14%, 5.14 rupees would be there. So a post-tax return of 1.41% compared to 1.46% would be there. Now the next part is pre-tax calculation. These pre-tax calculations would help us compare alternatives. So that's why we would say, okay, what is the pre-tax here? In this case, 4.68 is tax-free. So the effective one, or just see the first row, 4.68, because you're in the tax bracket of 30%, you should effectively be getting 6.69%, because 6.69% into 70%, when you reduce the tax part, would give you 4.68. But 65 paise is not changed. So what you get is 6.69 plus 0.65, which is 7.34. And on a rate of 365, it gives you a pre-tax per quarter of 2.01% and annualized of 8.04%. So now your comparison becomes easier, because you say, okay, now 8% is the kind of return that I'm getting in a REIT, whereas some debt instrument is offering me 7% or 7.5%. So this is a little better on that account. So the meaningfully compare the alternatives would be best, we feel, should be a comparison of pre-tax return, a correct pre-tax return, which enables better investment alternative comparison. Alternatively, one can go for a post-tax return, which is also very acceptable. You can just see the post-tax return, but you should definitely ignore the yield part, which is 21 by 350, which is 6%, because it really does not give you a meaningful picture. Thank you. Do subscribe to our videos if you like the video, and you can also visit our trainings page and connect with us on mail, WhatsApp, or Telegram. Thank you so much.